It's going to be worse than I thought. I'm your host, Steven Van Metre, and thanks for joining me today. The Federal Reserve made an announcement today that's going to slam the brakes on the economy. Just how bad is it going to get? Well, let's find out. They announced that the target range for the federal funds rate is going to increase by 0.25% to 0.5%, and that every meeting going forward is a live meeting, according to Federal Reserve Chair Jerome Powell. And if we conclude it would be appropriate to raise interest rates more quickly, then we're going to do so in a very hawkish tone. The statement also signaled that the Fed could soon announce and implement a plan to shrink its $9 trillion asset portfolio. The central bank ended this asset purchase stimulus program just last week. In fact, he mentioned that they even put a plan together on how they're going to do it, and they're just waiting for the right time to announce it. Talk about going from easing to tightening in a moment's notice. New projections show that most officials expect the federal funds rate to rise at least by 1.875%, or to at least 1.875% by the end of this year, according to the median of 16 officials, to around 2.75% by the end of 2023, and to hold rates there, if they even get remotely close to that, in 2024. That implies a total of 7.25 percentage point increases this year, and another 3 or 4% next year. And that's going to slam the brakes on the economy in a major way. In fact, they think that there aren't a whole lot of risks out there. But you know what? There are. Economists say there's a growing risk that Mr. Powell could feel the pressure to lift rates to levels that tip the economy into recession. As I've suggested, that would especially be the case if policymakers conclude that consumers and businesses' expectations of future inflation are rising, or if officials see growing evidence of a wage price spiral in which workers coping with climbing price demands and more pay increases, leading businesses to continue raising prices. And this is going to have massive implications. And when I show you how bad it's going to get, wait till you see this next chart, because it's going to really cement just what a foolish move the Fed is making. Let's take a look at one of my favorite charts, the real disposable personal income, real being inflation adjusted. And now we're going to overlay the federal funds rate. And I want you to see how a tightening of monetary policy affects your take-home pay and what you're going to spend. And so you'll notice here in red, when the federal funds rate was rising here in the early 70s, look at what happened to real disposable income. It came crashing down. And then they did this again in the kind of the mid to late 70s. Up goes the federal funds rate and comes crashing down real disposable personal income. Now you'll notice it happened here again in the late 80s. Federal funds rate going up, your spendable income going down. Now, there's a couple of times we can see here kind of in the early 90s where they both rose in tandem. And we can see that here in the late 90s, early 2000s, it did again. But most of the time, we see what happened here kind of in the early 2000s. Again, federal funds rate goes up, you spent a real personal disposable income down. We saw it again in the 2016 rate hike cycle. But now, we're starting this rate hike cycle when real personal disposable income is at a minus 10% year over year. So we've had a complete withdrawal of fiscal stimulus, and due to inflation, there's not going to be any more of that. That's gone. We have now stopped quantitative easing, when by doing so, that has an effect of actually raising rates. And now we're starting an actual rate hike cycle with a whole bunch of rate hikes on the table and a balance sheet unwind potentially coming by the summer, as Powell has suggested in the past. Now, what does this mean is going to happen? Well, if we'll go back and look at this chart, if every time we saw the Fed a rate hike cycle and a downward spiral in real personal disposable income, what had happened? It led to a recession. So what this is suggesting is that the Fed is about to send us into a recession, whether we like it or not. And if you're concerned at all about how your portfolio might perform in a recession, well, you shouldn't be. Be sure to check out Portfolio Shield. I'll put a link in the corner and the description below. You'll be glad you did, because it's going to get even worse. Now, I want to show you, because one of the highlights that Powell mentions is how strong the consumer is here, and I want to show you how that's changing too. Retail sales rose a seasonally adjusted 0.3% in February over the prior month, the Commerce Department said today, a slowdown from January's unusually strong 4.9% increase. So consumers spent more on gasoline and vehicles while cutting back on online spending and purchases of discretionary items such as furniture and electronics. But it should be noted, and we've talked about in this past, that retail sales are not adjusted for inflation. So we don't actually know how bad it is because the government won't tell us. All they're telling us is it's higher, but I'm going to show you in here in a little bit how maybe the real number is actually lower. So excluding autos and gasoline, and as many of you know, gasoline prices are substantially higher, retail sales were down 0.4%. So people spent less money. While that has largely come down from the 5.2% rise in January, it could be an early sign that inflation is making people more cautious, or perhaps due to the fact that they have a negative 10% real personal disposable income from this time last year, that they can't actually afford higher prices, something that I have suggested is going to actually happen. Let's dig a little bit deeper into the report. Here you can see furniture stores down 1% month over month. Electronics down 0.6%, food and beverage. And now this surprises me because you think spending on grocery stores down 0.8%, you'd think that number would be positive due to the increase in food prices. But what that means is consumers are going from steak to hamburger and hamburger to something else. They're scaling back and not purchasing the high ticket items because they just don't have the money. Health and personal care stores down 1.8%. How about non-store retailers? This is online retail, down 3.7%, and yet people are bullish on companies like Amazon. But here's where you see the government officials really trying to cook the books. This is retail sales in adjusted and unadjusted. Now you might be wondering, well, what does that mean? Is that inflation adjusted? No. What it is seasonally adjusted. So the red line you'll see when we go back and look is kind of jagged. It moves around a lot. And so the government tries to smooth that out to make things look really nice and pretty. So that way it's not moving all over the place. But I want to suggest to you that the unadjusted number is actually telling us where retail sales are headed, and the government's hoping that it's going to change directions. Check this out. So you can see how that red line is jagged and moving all over the place, and all the government's doing with the seasonally adjusted or green line is smoothing it out. But you'll notice here back in June of 2020, the unadjusted number went down 1, 2, 3 months, and at first they did not change the seasonal adjustment, but had to make a big move down. And then going forward, everything gets smoothed out. Now look, we have 1, 2 months, and the seasonal adjustment number is up here, indicating that potentially if we get another month down on the unadjusted number, that all of a sudden we're going to see a big drop in the headline number. And well, the Fed isn't going to like that at all. And what is it? How do we know that consumers are going to spend less? Well, we can look at the University of Michigan Consumer Sentiment Survey, which is a phenomenal leading indicator, another one of my favorite statistics, that tells us where consumer spending is going. And here you can see consumer sentiment going back into the early 2000s, and you see it starts to head lower, and it leads just with a little bit of lag, retail sales on a year-over-year basis. And it makes sense. As consumers get less confident, they start spending less. And here you can see going into the great financial crisis, again, the consumer sentiment headed lower, and it took a while, but retail sales started, they dipped up, and then they started to head lower. So it does it with the lag. So consumers effectively start telling you, I'm not confident about this. They keep going for a while, and then when they realize the situation isn't getting better, then spending gets cut. And look at now where you see consumer confidence crashing and heading lower, because this is not showing the preliminary data. The Fed database does not show that. So indicating that retail sales are going to head lower as that unseasonally adjusted data tells us. And what happens now when we overlay the federal funds rate? Because one thing that's important to understand, what the Fed's trying to do here is they're trying to pull demand back. Now, if you're struggling with this concept, think of it like we're on an old steam locomotive and we're taking off, and the engineer's just shoveling coal into the engine. It's building up pressure, and the locomotive is going down the tracks faster and faster and faster. And that's what is seen as inflation. And the Fed now says, hey, you know what? This is a problem. We got to slow this train down. And the engineer looks to you, and you're the brake man and said, hey, we got to slow this thing down. There's a big turn coming up and we're going way too fast. So they release some pressure of the steam, but it doesn't make a big enough difference. So you grab the brake handle and you start pulling back on it and hope to slow the train down just enough to make that nice curve. And what the Fed believes is there's so much pent up demand and so much pent up energy in the economy that they can pull the brake back to slow inflation down without crashing the economy. But now, when you see what's going to happen when they raise the federal funds rate and consumer confidence is down, well, look at the relationship now between this and retail sales. You'll notice with a little bit better accuracy here, going back to the late 90s, early 2000s, the Fed raised rates had immediate consequence on the retail sales. Of course, now you'll know it had everything to do with the fact that sentiment was falling and real personal disposable income was falling. Now you look back here around 2004, 2005, Fed's raising rates, retail sales slow down. And now we go to 2016, Fed raises rates, retail sales pick up a little bit and then kind of starts to slow down. It never really launched off and never got back to some of that higher level that it was at. So again, what is going to happen here is the Fed is going to crush demand, and retailers are now starting to stock up on inventory, and that's not good either. So here's the retailer's inventory, and you see it's moving back to pandemic levels, even though we keep hearing about shortages. Now that number's not inflation adjusted either, so I did inflation adjust it. I subtracted the consumer price index, and so what we can see on an inflation adjusted basis, and then on a year-over-year basis on top of that, that retail inventories are getting close to where they were a year ago, and soon we'll pass that. And if they aren't moving product, well, what does that mean? Well, that means orders are going to stop and manufacturing is going to slow down, and you're going to see it reverberate through the economy. And of course, we can't end today's show without talking about crude oil, because we had the crude oil data today, and this is real important because I mentioned that crude oil was likely to head lower, which would bring inflation down. Well, here's the evidence for you. Looking at the weekly Cushing ending stocks, remember we've looked at this a couple times where these periods in around 2015, 2018, and now are where inventory levels at Cushing, Oklahoma get really low, and that signals a peak in crude oil prices. Well, maybe it's just 1 week that starts the difference, but look at this crude oil inventory surprise. The experts rose 4.3 million barrels, and how about this at Cushing? And both were negative numbers for rose 1.8 million barrels. Again, 1 week doesn't make a trend, but it could be just the beginning of what we're about to see. And with that, I appreciate you being fans. I appreciate you watching, and we'll see you tomorrow. I'm Steven Van Metre. Bye now. The content of this video is provides educational information. It's not intended to provide investment advice. You don't have to be construed as recommendation or solicitation to buy or sell security financial instrument or participating in particular trading strategy. This video was prepared by Steven Van Metre. Personal capacity. Opinions expressed in this video that do not affect the value of Inc. or Steven Van Metre Financial.